just pause for a moment and appreciate that we've got 3 high-profile accountants coming here, donating their time to us to help us get ready for tax season. That's very gracious and generous. Big hand for that. Now, I know paying taxes isn't necessarily the sexiest topic, but it's one of the most important topics because how much you make is exciting, but how much you keep is really what keeps your lifestyle going. So that's what this presentation is about. It's not about what you make, it's about what you keep. And I'll tell you, every single year I submit my bookkeeping to these guys. I think I know how much I'm going to keep, and then the amount they tell me I'm actually going to keep ends up coming back higher. So I can't give them a better compliment than that. So without further ado, I'm going to invite the team from MNP up here to give us some tax tips for real estate investors. Take it away, guys.
Thanks for having us here every year for the last, I think it's our 3rd time. There we go.
There you go.
All right, so I'm Jon Garcia. I'm a partner at MNP. I'm a general practitioner, and what that means basically is I don't specialize in a special area like Michelle is in tax, Michelle's in tax, she specializes in tax. Kat is like myself, she's a private enterprise. We do nonprofit audits as well, but really, you know, we're the, I'd say, quarterbacks of our clients, and we get all our niches and service lines involved in maybe between tax specialists, corporate finance, anything like that. We're the people that they probably come to us first, and then we get specialization from the show. So today, the agenda is, I'm going to start off with personal tax changes for 2017. There's not that much. Then I'm going to turn it over to the girls here. Kat's going to talk about business structures, and then I think Michelle's going to take the rest of the presentation and talk about rental income and expenses, and then some other items to consider, and then we'll open up to questions. I think a lot of people really like the question period, and then we do stick around, so if you're shy, please come talk to us after the presentation.
Can I just comment?
Yeah.
We didn't bring as many packages as there are people. So if you did not get a package of the slides and you're hoping to get one, get our email addresses and we can email it out to you. And then it's also going to be available to as PDFs on your mobile site as well. So whichever works for you, or perhaps both. We'd love to hear from you.
So personal tax changes for 2017. In the news, there's all this talk about tax changes. Most of those are small business changes, actually. So my little part of the slide is pretty quick. There was new legislation proposed in 2016 requiring all homeowners to basically report sale of their principal residence on their tax returns, whether they're taxable or not, basically. If not reported, taxpayers will be subject to an extended period of a reassessment. So basically, tax returns are statute barred 3 years after they've been assessed. So if you miss like some kind of filing, they can go back and open up those tax returns, and then they'd be opened up again from being statute barred, right, basically.
Yes, and an additional 3 years for missing.
Exactly. So it's kind of important to look at those things. So 2016 tax returns, if you guys sold your properties, personal properties or whatever, those were already being done. So that's somewhat new. It was October 2016. So if you missed that, please maybe talk to your advisor and get that put in your 2016 tax return. But for 2017, for sure, that is for sure happening all the time. And the reporting requirement is applies to either if they're actual or deemed disposition, and a deemed disposition could be like a death. If you were a change of use, I'm assuming is a deemed disposition, where if you were in a principal residence and then you're going to rent it out, that's a change in use, where you would have a deemed disposition, or vice versa. If you were going from a rental and you were turning it into a principal residence, that is also a change in use, which could be a taxable event. So please talk to your advisors about that. There's late filing penalties for these kind of things, unfortunately. You can file them late, but they're always subject to late filing penalties. And CRA is doing whatever it's called, land title searches and such like that to see if people change land titles, and that's how they kind of get you on that. So ensure all real estate dispositions are recorded. Oops. So tax credit for education, I know this is a very young group, so I don't know if you guys have any kids in school or tuition, but basically they eliminated the education and textbook amounts starting January 1st, 2017. So basically you used to get like $400 for every full-time month that you went to school, or like $350 for every part. I don't know the numbers, but something like that. They got away with that. So you can only claim tuition now. And then now they've opened it up to occupational skills courses such as, I don't know, like a social worker program or something like that, some vocational schools and such. So that's good. And then the anti-avoidance rules for registered plans. So basically they've extended the program not to include RESPs and registered disability savings plans. So RSPs, RIFs, and TFSAs, they've always had these specific things that are prohibited from investing in. And now they've opened it up to these RESPs and such. So basically, if you're like a day trader or something, that's one of those things you can't have a TFSA and be a day trader, basically, because if they look at it as like it's a business, basically, right? So pretty simple stuff. I mean, seems simple, but to us anyway. And then yeah, so the structures and considerations, I'll turn it over to Kat, right?
So I'm going to talk a little bit about business structure and the types of structures that you may consider when you want to start your own business. So there's three main structures. The first is a sole proprietorship. There's a partnership and a corporation as well. Those are the main three. So first let's talk a little bit about sole proprietorships. So this is the simplest way to start. All you have to do really is just start a business. There's no legal considerations you need to make. There's no filings that you need to do. Your business will be filed with your personal tax return. So it's definitely less costly. You don't need to get a lawyer right away. You don't need to purchase shares. You just start running your business like a business. But we do suggest that you always have a business bank account, even if you are going to be a sole proprietor. It's really, really important that you keep your business expenses and your personal expenses separate. So that's definitely something you need to consider. And then, like I said, all that income is just reported on your personal tax return. There may be some tax advantages to doing it this way, especially in a startup. You tend to have some losses in the first year. It's really expensive to get a business started. So those losses can actually be applied against other income you earn, like another salary, for example, and so you can take advantage of those losses. There is some risk, though, you need to consider. So in a sole proprietor, because you're not a separate entity, you are just one, you and your business operate together. So if someone was to sue you, your personal assets could be caught in that suit, and you could potentially lose them. So that's just something to keep in mind. The second type is a partnership. So partnerships can be come together between individuals, corporations, trusts, or even other partnerships can form a new partnership. So they're very, very flexible. They can be formed verbally or by a written agreement. However, we always suggest having a written contract. That way, when it comes time to distributing income, there is no questions. It's all already specified in the partnership agreement. And it's a little bit more informal than a corporation. You don't necessarily need to divide the income based on who owns the partnership units. You can choose to divide the income or the losses based on the partnership agreement. And that partnership agreement can be flexible, and you can choose how you want it written. And then finally, the next type is a corporation. So this is where we'll spend the most amount of time talking, just because it can be a little bit different. So a corporation is a complete separate legal entity from you as an individual. So with that, it tends to be more costly to start up. There are annual returns that have to be filed, and you also have to have certain legal agreements written, so director's resolutions potentially. You'll need an actual share structure broken out, and you'll actually need to purchase those shares. So that's something that's really, really important that people tend to forget. So when you are starting a corporation, you really do need to write a check from your personal account and deposit it into your business bank account to show you purchased those shares. It seems really simple, but it's something that people often don't do, and it can get you in a lot of trouble. So make sure you do that. But there are other advantages to having a corporation. So there is, corporate tax is a lower rate than personal tax, so that there is a deferral. That money does stay in the corporation when you pay that lower tax, and then you can take it out via dividends or salary. So if you're not using all the income you earn in 1 year, a corporation might make sense for you. There's also some legal protection available since it is a separate entity. So the assets are the assets of the business, and if that business is sued, those assets are the only ones at risk. However, with that being said, if you are taking on debt or any other sort of form of debt, if you sign a personal guarantee, those assets could be at risk as well. So just be careful with that. Personal guarantees still could affect you personally, but if you just have no personal guarantees, the assets in the business are the only ones at risk. And finally, you can choose what you want your year-end to be. So you're a sole proprietor where your year-end is December 31st. In a business, you could choose January 31st, and that actually could give you an extra full year to do tax planning, which is really exciting because we just hit our filing deadline today for any dividends, and if you're a December year-end, it can be hard to get them out and know exactly what you want to do for the entire year, just till February. So that's something to think about for sure. So also, let's talk about some proposed tax changes. So on July 18th, the federal government released some pretty crazy changes, some of the most significant changes that we have seen in the last 45 years. Their three main sections are taxes on split income, or TOSI, which we'll talk a little bit more about later. Also, the holding passive investments in a private corporation, and converting income into capital gains. So they had a 75-day consultation period, and over 21,000 submissions were received of people mostly complaining about the rules and the problems with them. And so they did come out with some additional information on the week of October 16th, talking about TOSI and the rules about splitting income. So really what that means is in the past we were able, if two people owned, specifically spouses owned a corporation, we could choose to give dividends to each spouse, and we could use advantage of, if one spouse had a lower income on their personal taxes, we could take advantage of that lower income by declaring them a higher dividend and use those brackets, those personal tax brackets, to pay a lower tax. So CRA thinks that this is unfair, and the federal government thinks this is unfair to the average taxpayer, and so they made some rules about when we can and can't do that now. And so they finally did come out with some more guidelines on those changes on December 13th, and they were confirmed yesterday in the federal budget. So those will be in effect. And I just want to say, make sure every business is individual, and the rules regarding your specific business might be different than the person beside you. So just make sure you're going to see your advisor about these proposed changes, as well as seeing if a corporation really does make sense for you, because it doesn't all the time. Corporations always sound great, and people always think that that's exactly what they want, but it doesn't always make sense. So please talk to someone about your specific idea and what you'd like to do. Next, we're going to talk a little bit about business plans. So when you want to start up a business, why do we need a business plan? Why is it important? We want to make sure that the idea you have is viable, that you're priced competitively, and that your focus is what it should be on. So what are some components of a business plan? Make sure the entire thing is written in plain English so that anyone could read it. That's the most important part. Some of the components include a cover page, a table of contents, an executive summary, sort of, so if someone wants to just read a one page and understand what your plan is, they can do that. Your overall goals and objectives and what you're really trying to get into, what your management plan is and what your key performance indicators are, what your marketing strategy is and where you want to place yourself in the market, what your financial projections might look like, and this is probably where you're going to spend the most amount of time because it can be hard to get those projections correct. A list of who your advisors are, a conclusion, and any appendices that you might want to include to show how you sort of came to your idea and how you can back that up. So next, selling the plan. How are you going to actually sell this plan? Make sure you can describe your idea or your investment in 2 minutes or less so that if you're just having a conversation with someone, you can describe that entire plan to them right away. So some ideas are, why did you choose this one over other ideas? Is there a demand? How do you know there's a demand for your idea? Who's the target market and how are you going to place yourself in that market? And if you're selling a service or a product, what is your price and how do you know that that's the appropriate price? So, and make sure we always consider the costs. Costs of a startup can be significant. So you want to think about how you're going to finance your asset purchases. How will those asset purchases be secured? Are you going to have a personal guarantee? What about reoccurring costs? So what about annual maintenance, taxes on that income, even just general overhead costs? How are you going to pay for those? And then always consider your tax on the disposition. So capital items, when you sell those, there's tax, as well as just selling your business. There's tax on that as well. Next, consider financing. So there's various types of financing, and financing for a startup is really important and can be very hard. So make sure you spend some time thinking about different types of financing. So we've got equity. This is the actual money that you're putting into your business. Whether that be through your share purchase or even through a shareholder loan where you personally are loaning your business money. You could also have just regular debt or bank loans, but remember these can be really hard to get, especially in your first year if you have no data sort of to back up your position. But they might consider with a personal guarantee, this might be an option. You could also think about a line of credit. That actually works a lot for startups especially. Line of credits are great because they also are usually interest only. So when cash flow can be tight in the beginning years of your business, line of credits are really good. Crowdfunding has also become really, really popular. Places like Kickstarter are doing really, really well. And this is sort of a new trend. So hey, why not something you can try out for sure. And then family and friends are always popular with a startup because they generally know you and are willing to lend you money. But just be careful, it can get tricky. Family and friends can get tricky, especially if the startup doesn't do as well as you're hoping. So just remember to keep that in mind. And how are you going to keep your investors happy? Well, make sure you provide them with up-to-date information. So let them know what's going on in your business, what your ideas are, keep them updated on anything you sell or any new developments that you have, and always provide them with annual financial statements so that they can actually see that this is something that's important to you and that you are actually making the effort and trying. And I just want to, again, remind everyone the importance of keeping your business and your personal accounts separate. I can't tell you enough how much easier it is if you start a business, you have that business bank account right away, you keep your personal expenses in your personal account and your business expenses in your business account. It also really helps with monitoring your cash flow. The number of businesses we've seen fail just due to cash flow is massive. I would say so many businesses have had great ideas and have great potential for revenue, but they just don't know how to monitor cash flow. And if there's no cash in the bank to pay bills, it's not going to be successful. So make sure you're monitoring your cash flow, and doing this, you'll know right away what expenses are coming out, and so have some software that's going to help you do that. There are so many apps out there now that just link directly to your bank account that will tell you right away what checks are coming out and where your balance is at, and having good accounting records, that really, really does make a difference. And then maybe consider having an emergency fund. What happens if that tenant ends up leaving and you were expecting that revenue that month and it's not there and you need that cash to pay bills? So always consider having either a line of credit or your own emergency fund personally that you can draw upon if that happens. And then let's talk about tax, because this is everyone's most excited part. So what's deductible in a business? So pretty much anything that you incur as an expense to earn business income is deductible. So this includes office expenses, insurance, legal and accounting fees, meals and entertainment if they are used in order to earn income and take clients out, freight, repairs and maintenance, pretty much anything that you could think of. And then how do losses work? So I talked about in a sole proprietorship, those losses can be used against your personal income through a salary. But in a corporation, those losses actually stick with the corporation. You are able to carry those losses back 3 years. So if you've had a loss in 1 year, but you paid income tax in the last 3, you can totally carry those back and get that money back. And then you can also carry them forward for 20 years, but you can't use them personally. So that's something to think about. And then what happens if CRA comes knocking? So what do they want to see? They want to see your actual receipts. So make sure you're keeping your receipts. It's very good practice anytime you're going out with a client, you're taking out a client, to be writing their name and why you took them or what your conversation was on the top of your receipt. And that way when CRA comes back and says, hey, we don't know if this is a reasonable expense, you can say, no, I took this client out, this is what we discussed, and this is how it earned the income. And it's pretty hard for them to turn that down. So that's always a good practice. And also make sure that you either keep those receipts, either scan them or keep them for at least 7 years. Because that's the time that CRA requires you to keep those. And I'll pass it on to Michelle.
Scrap your slides here.
So I want you, some of you who've been here before will have seen some of these slides before, but realistically, these are items that come up over and over again, so items that you should be familiar with. And also, they're the items that we get the most questions about. So revisiting them again, I think, is worth taking a bit of time. So first we'll talk about some expenses and things specifically with rental properties, and then just some overall tax things to consider. Because I don't know why you guys didn't think the tax was exciting. I mean, it's what I do all the time. The tax act is great. But rental income reporting, rental income is reported on an accrual basis. You can use cash basis. CRA does allow you to do that, but only if it's going to get you the same result as if you did it on an accrual basis. So you might as well do it on an accrual basis. So if you have little or no accounts receivable, you have an ability to use a cash basis. Rental income is reported based on the percentage ownership. If you have either spouse you're splitting it with, or with a partner, or however you are splitting it. That being said, you need to pick something and stick with it. CRA really doesn't like it if you split it 50-50 1 year and 20-80 the next year because somebody earned more income in something. So it should be split. Because if you're perhaps considering one of those parents is going to be a stay-at-home parent, maybe that property should be reported from day one, 100% on their return, because they aren't going to have income from another source potentially in those future years. But keep in mind as well that eventually when that property sells, also that capital gain will be 100% theirs. So, figure out the numbers, figure out what makes sense, but there's definitely a lot of opportunity for planning. Other related income that you should be reporting as well, besides the rental income itself, are premiums for granting or extending a lease, premium for canceling the lease, sharecropping, which is probably not something you're seeing a lot, but we do have farmland on the edges of town, so you may. And losses including uncollectible debt or rent. So you have two basic kinds of expenses. Katrina was mentioning those earlier, but you're looking at current expenses and capital expenses, and those are probably the items that CRA has the most inquiries about with respect to rental properties, and also some of the items that have gone to court the most for big amounts. So Current expenses, obviously, things that you can claim in the year that you incur them. So they're recurring expenses that provide short-term benefits. So they're things that you would have to do over and over again to keep the property at the same level of condition it's in now. So repainting walls, fixing leaky faucets, those kinds of things that you have to do to keep the property going. Capital expenses, and those are expense in the year that they're incurred. Capital expenses are things that provide a benefit that sort of extend the life of the property or increase the value of the property. So those are things where you are perhaps replacing wooden steps with concrete steps because those are extending the life of the property, replacing asphalt shingles with a metal roof. A lot of renovation costs are actually going to be capital costs. They're increasing the value of your property or increasing the life of your property. And those items cannot be deducted in full in the year that they're incurred. Instead, they're added to the value of your property or added to the value of a leasehold improvement, and then they're depreciated over time. So capital expenses, CRA looks at some defining factors of what they consider to be reasonable in order to decide whether or not something is capital or current. But some of the determining factors, and there is a lot of gray area here, but some of them will be, does the expense provide a lasting benefit? So again, does it make that property last longer? Does the expense maintain or improve the property? Is the expense for a part of a property or for a separate asset? So when you're sort of thinking of those items, if you're buying appliances for your rental property, those are items that should be capitalized. They're separate assets, separate from the building itself. And then what is the value of the expense? And although there is no bright line test that says everything over 500, everything under 500, it's not unreasonable to sort of step back and say, how much did this cost? Yes, it may be adding to the value, but it costs $300. So use some common sense on what you're claiming or not. And generally, just don't be greedy when you're claiming it. The higher the level of your expenses, the more apt they are to be looked at. So you're going to want to make sure that you have good justification for why you claim what you claim. So capital expenses, there are some special circumstances for some of those categories as well. Modifications to accommodate persons with disabilities are typically considered current expenses. So whether that's your property or fixing something to have someone come into your house, although we're talking rental properties, some of those expenses can be claimed as current medical expenses on your tax return as well, if you have someone living in your home. But getting a rental property prepared for a disabled individual is a current expense. Buying an older property and getting that property up to standard to be able to rent, that's going to be capital. You're improving the value of the property. You may not deduct costs that are related to personal portions of your property. So if you are renting out your basement, for example, you should be allocating things reasonably. So if you're looking at square footage or number of rooms or some reasonable base to divide things like property tax and other items like that you get a single bill for your property. And costs related to construction, renovation, or alterations, they're going to depend on the facts of the situation. So again, think of those defining facts that we were looking at on the previous slide. Types of expenses. We mentioned some of these already, and just before we even start, I'm going to be a Grinch and refer back to the Christmas gifts that were mentioned in the previous presentation. CRA really doesn't like it if you give cash or near cash. So if you give cash or near cash, which would be a gift card, to your tenant as a gift, that is potentially not going to be an eligible expense. So ponder that, but gift cards are better than cash, so don't give them cash. But also think about what kind of gift cards you're giving. So if you are giving gift cards to restaurants or theater tickets, entertainment, those types of things, are only going to be able to be deducted at 50% of the cost, because all meals and entertainment expenses are 50%. So if you do want to give a gift card, contemplate using a gift card that is for a retailer where they're actually going to buy goods. So whether that's a furniture store or Staples or Walmart or wherever that you think that they may use it. Grocery store cards are a little iffy because they're kind of meals. So that one is definitely a gray area. I would stick more with items. And where possible, and bottles of wine are meals and entertainment as well. So I could just see people's minds just clicking, like, what could I give? So when you're thinking of giving gifts, consider giving an item if it's at all feasible to do that. In a lot of cases, a gift card is going to be what someone may need the most. So you know your tenants and know what you're giving, but just keep in mind what risk you're taking by claiming that expense. And so now that I've rained on that parade, we'll talk about what we can claim. You can claim advertising, interest on money that you borrowed to buy an investment property, but only the interest. So I don't know how many times I've gotten the whole little box of things and it's saying, okay, I have spent $50,000 on my payments this year. You may have, but I can actually only deduct the interest on it rather than your full mortgage payment. That's also line of credit amounts as well. We were mentioning earlier that it's very important to keep those accounts separate. CRA has done several projects where they will track interest expenses that are being claimed. And it's very difficult if the line of credit is mixed between personal and business to determine what amount will actually be claimed. And the default will actually be towards more being personal than business. You're going to really have to defend that business amount. So wherever it's possible, keep those separate. Office expenses, so stationery, that type of thing, ink cartridges, things that you have to use to get your word out there. Legal and accounting and professional fees. Management and administration fees, repairs and maintenance, which we discussed already, landscaping, obviously not putting in a pool, but you know, the typical snow shoveling, mowing your lawn, utilities, and lease cancellation payments and condominium fees. Motor vehicle expenses are one of those sort of weird things when you have rental properties on what you can claim and what you can't. So first off, driving to collect your rent, you can't claim the mileage for that. But if you are traveling to do repairs, to meet with tenants, to discuss their concerns, whatever other reasons there are to be there or showing the property, those types of mileage can be tracked. But what you can claim is limited in some parts to what you own for the properties. So if you only own one rental property, and it can't be in your house, by the way. You can't travel to your own house. You must meet all of the following criteria. The income earned has to be from property in the general area where you live. General area is not a defined term, so whether you choose to decide the general area means within the city, within the province, within the country, you must be ready to defend that. And you must personally perform repairs and maintenance tasks. And you have expenses to transport tools and materials. So we mentioned you can't claim expenses to collect rent. If you own 2 or more properties, you can deduct expenses incurred to collect the rent and to supervise repairs and manage the any things that happen within your rental property. The properties have to be located in at least 2 locations away from your principal residence. And again, not a defined term. I mean, there's no reason why those properties cannot be side by side on the same street, but you do have to have 2 properties that are in a separate building from each other. Okay, other expenses, home office is one that is quite often claimed, and not just by self-employed individuals or individuals with investment properties, but also commission salespeople. CRA loves checking this one. So home office, in order to claim it, just because you have a space that you work in doesn't necessarily mean you can claim it. The office has to be either the principal place of your business, so where you do all of your property management and those types of roles, or it needs to be exclusively used for the purpose of earning income from the business, so you can't use it for anything else. So it's kind of hard to argue your dining room table is an office. Because you probably use it for something else as well. But where you're actually getting caught is the and. It's and it is used for regular and continuous basis for meeting customers, clients, or patients of the individual. So most people in their home office are not having clients or typically strangers coming into their home. They're normally meeting them someplace else. So it does quite often drop down in that. So if you are planning a home office, again, be ready to explain why that home office is a viable expense for you. Some items that you can't claim, just right off the bat. Land transfer taxes, more of a concern with British Columbia properties where that transfer tax can be quite prohibitive. Mortgage principal, which we discussed already. Penalties, particularly penalties for late filing of taxes. CRA does not let you deduct late filing penalties or interest. Also do not let you deduct traffic tickets. So if you are speeding to meet your new tenant, unfortunately that is not a deductible expense. You can't deduct the value of your own labor. And also personal expenses, which is logical. Just what we're going through next are just some overall, but currently, you need to consider the intent of the original investment. And CRA will request documentation if they choose your property as one that they're looking at. So, making sure that you have your documents in place, looking at what your history is and what you typically do. Do you buy properties and flip them on a regular basis? If you're rotating properties through, you are probably in the business of flipping properties and developing properties, and your income is business income rather than capital on those properties that you're selling. If you're buying properties, keeping them, earning income on them for a period of time, selling them when a good opportunity comes along, those are likely going to be considered capital expenses. Capital income. So think about what those are, but think about the risks of that as well and sort of plan for that. There is always an argument either way because your intention may change based on what the market is, an opportunity that comes along. So a property that you had purchased and had intended to keep as an investment property, you may flip quite quickly just because the right offer is there. So make sure that you're documenting why there's been a change. CRA likes paper. They like documents. The change in use, John mentioned that earlier when we were talking about deemed disposition. So if you're changing a rental property into a principal residence or vice versa, there are tax implications. You do have to report it as a disposition. You do potentially have an ability to file an election, particularly when you're changing from your principal residence to a rental property. You have an ability to file an election to claim the principal residence designation on that property for up to 4 more years. So in some cases, depending on what else you have going on, that may be a viable election for you to make. Where we see it most often is when we have university professors, for example, who are going to teach someplace else for 2-3 years on a contract. They're renting out their property while they're away because you don't want to leave it empty. But they don't want to lose the principal residence ability when they sell that property eventually. So they file that election, so for up to 4 years they can say, yes, I didn't live there, but that's still my principal residence and I have not designated anything else as my principal residence at that time. You can only ever designate one property as your principal residence at any time. Typical rules are that you do need to be living in it, or an immediate family member needs to be living in it. You're limited to half a hectare of property typically, unless you can somehow claim that you required a little bit more for use of the property, whether that's a regulation in the community that you're in on how big your property has to be for subdivision, whether it's access to water, access to power. You have some leeway, but typically half a hectare. So think about making those elections. That is an election that can be filed late. And because of the value of property, it sometimes is still worth filing late. The penalty for late filing, though, is $100 a month up to $8,000. So, but still, given the value of some properties, that $8,000 penalty may still be worth offsetting some of the gains. So you have to run the numbers to see whether or not it was worth doing. But because that is a complex issue, make sure you talk to your financial advisor before you file any of that paperwork. It needs to be filed with the tax return in the year that the transaction happens, unless you're filing late. You might want to consider an appraisal of the property at any time you're doing a change of use. Again, so you can defend that value at the year that the change happened. It doesn't necessarily have to be an official appraisal, although James can certainly put you in touch with people who can do appraisals. And so, there's a great network of people that you can be in touch with, and you have confidence with that figure if you have a third-party appraisal. But you can also talk to a realtor about what the value of other properties in the area are like. Just make sure you have good supporting documentation, not, well, I think it was probably worth $20,000 more than when I bought it. So make sure that you just start popping some of those things in your file as things change. Ownership of foreign property. Because why not have a vacation property someplace warm? It's been a yucky winter. So have some options. If your property is personal property and you're only using it for yourself and rent is incidental only to cover costs, you don't necessarily have additional reporting requirements. But for a property that is earning income, individuals who own foreign property with a cost of more than $100,000 Canadian might be required to file another form called a T1135. The penalty to not file this form is $2,500, so again, you want to make sure you file it if you're supposed to file it. The threshold for reporting is based on the cost amount, and it's the aggregate cost amount of everything that you have. So it would include property, perhaps you have U.S. investments that you're purchasing on the New York Stock Exchange. It's adding up those foreign items. The other thing that is a bit tricky, particularly in the year that you purchase or sell a property, you also need to consider the value of the foreign bank account. So if you had cash that was sitting in a lawyer's trust account waiting to make the transaction, even if it's your personal property, that trust agreement or that trust account may put you over the $100,000 threshold. And for the sake of one schedule to fill out on your tax return versus $2,500, it's worth doing the paperwork for. Revenue Canada's request for support. As part of the announced tax changes, the government has also announced a significant budget increase to allow Revenue Canada to have additional auditors and reviewers. So we will have more auditors and reviewers available to look at things than ever before. And also CRA has access to more information electronically than they ever have had before. So they have an ability to track and question and send out education letters, whether or not you might have something. Sometimes they'll give you a gentle nudge. You'll get a letter that says, it's possible that you have a rental property. Have you perhaps not reported that? And give you an opportunity to catch up. But in other cases, they're doing projects to check whether or not things are being reported properly. And because they have the ability to track land titles, to track bank accounts, to track your trips back and forth across the border, there's a lot more ability to figure out where things are and where things are happening. And because we have more people doing reviews, we're seeing more projects. Some of our clients who have rental properties are getting full questionnaires. We are asking, and we would ask you that unless you're supremely confident in dealing with the CRA on your own, to speak to your advisor before you even write anything on that document. Because it's a lot easier to get that document filled out answering only exactly what CRA is looking for than it is to try to defend something and say, well, that's not what I meant to say. They're also looking at what the fair market value of rent is. They're asking whether or not you're renting to family. For fair market value of rent, that is something you're going to want to start to track as well. Not a big serious tracking, but just sort of keeping a file of what other properties are. You have access to great stats through this organization as well, so take advantage of those. Estate planning, and again, like I'm just this horribly depressing person because I ruined your Christmas, and now I'm going to talk about you dying, which is depressing, but does need to be planned for. Not everyone realizes, I mean, you are investing in really expensive things when you're buying property. And not everyone realizes that when they pass away, everything that they own is deemed to have been disposed of at their date of death. Now, if you have a spouse, those items could roll to your spouse at whatever amount you paid for them, and then that tax is deferred until that spouse passes away. And it's really not a practical tax planning tip to just keep marrying someone else. That doesn't work particularly well. So you do need to consider what the tax impact of that will be. So if you sort of plan for the worst case scenario that there's not an ability to roll to a spouse, you're looking at potentially having the gains on every property that you own brought into your tax return all at once. So that can be a significant tax bill. For most individuals, the year that they pass away will be the highest tax bill that they ever have. And you have to figure out some way that those taxes are going to be paid, because you want your properties to go to who you intended them to go to. You want them to be available for your family to be able to continue to earn income from. You don't want to have to sell a property to pay taxes in a crappy market. So looking at planning some of those things, thinking about what that worst case scenario could be, consider how your assets are owned. Perhaps it's useful for some of those properties to be jointly owned. Perhaps it's not. In some provinces, BC in particular, you don't just want to willy-nilly add people to property. Because the transfer disposition and you have transfer taxes. But consider possibly purchasing life insurance to fund that amount of taxes that you will have. Particularly when you're of an age where life insurance is actually a reasonable price. So think about some of those things. Make sure that your family and advisors know what direction you want to go and what you want to have happen. Perhaps you want to donate some of that property to offset some of your taxes because you would rather your property is used as a legacy for yourself rather than to pay taxes. So just keep in mind some of those things, make sure your will's up to date, and again, I'm sorry for the depression, but it's a good way to end. And then just overall, although we are quite confident that MNP is the greatest, and is why we work there, we do recognize that you have really good relationships with advisors and are working with people already. We don't intend to be stepping on that at all. But if you have an advisor that's perhaps not comfortable with a particular planning issue, we certainly quite often work with other accounting firms or bookkeepers or accountants to come in and deal with one issue and provide and guidance to you and your advisor, and then sort of step back and you continue that long-term relationship with that individual. So that's certainly something that we would be happy to do. And that was everything that we had.